And Mike, I'm all set. I'm gonna sort this out with Kristen later. Thanks.
Okay, then, Angela, are you with us?
Yeah, can you hear me?
Yep, I can hear you.
Perfect.
Okay, can we go back on the record, please?
On the record, 107.
Thank you. Miss AC, do you have redirect that you'd like to do?
Yes, thank you very much, Mr. Barber. It's green. You've been asked about a lot of numbers this morning. I just want to take you back to a couple of the numbers. In your pre-filed testimony, which is Exhibit 19, on page 13, you referenced, and you were asked about this earlier, an underwriting gain in 2025 of 47.3 million. Do you see that figure?
I do.
And you recall being asked about that figure earlier this morning?
I do, and it's on exhibit page 14.
Thank you. Yes, the red pages. And I think you testified that that's an entity-wide figure for 2025, right?
Correct.
Does that include the one-time settlements with Optum and UVMMC that you were also asked about this morning?
It does.
And those settlements were, although they were received in 2025, do they in part relate to prior plan years?
That's correct.
If we take a look at Exhibit 10, which is a one-page exhibit.
I'm there.
And I think you were asked about the gap figure for operating gains and losses. And under that gap figure, which is the second line, and the third line, there's a line that says adjustment for prior year restatements. Do you see that?
I do.
So the second line, the operating gains and losses line, where there's a roughly $47.5 million figure, does that figure also, although reported somewhat differently, include those one-time settlements with Optum and UVMMC from last year?
Yes, it does.
And in this line that indicates the adjustments for prior year restatements, is part of the adjustments adjusting for those one-time settlements back to the prior years that they were related to?
That's correct.
And is that adjustment already reflected in Exhibit 1, page 6, the tables that you've looked at a few times this morning?
Yes, those adjustments are reflected in table 2 and 3.
So, for example, if part of one of those settlements was attributed to plan year 2023, the loss figure for 2023 has been updated to reflect receiving that money.
That's correct.
Thank you. I think that's all of the number reconciliation. We were also asked a number of questions this morning, of course, about the CTR request, Blue Cross's request for 5% CTR in these markets. You were asked about the reasoning that you provided in your Exhibit A. You referenced in Attachment A the concept of rate shock. Could you address that for the board this morning?
Yes, I can. As I noted in the memo that I wrote to Ms. Lemieux on May 8th, I note that maintaining an adequate level of member reserves, this is on Exhibit 19, page 27. Maintaining an adequate level of member reserves is critical for any insurer, and consequences of inadequate member reserves include reduced flexibility in responding to members' needs and a need for higher CTR and future rates in order to avoid further deterioration, also known as rate shock. And I just wanted to draw the rate shock concept back to the risk and the uncertainty that if we continue to have negative CTRs in this market, then that forces future rate increases to be higher. And so it's just another way of framing the need to have an appropriate CTR in each year's rate filing.
Thank you. I have nothing further at this time in the public session.
Thank you. Mr. Schulteis, anything on those topics?
Nothing from us, Chair Barber.
Board members, do you have any follow-on questions from the redirect?
I have one quick one.
Go ahead.
The 47.5 million that we were discussing, 47.3, 47.5, how about we'll call it roughly 47 million. Is that, is the $30 million loan, is it 47 plus 30 or is it 47 minus 30?
So the $30 million loan doesn't play into that number one way or the other. It's,
Did you, I guess, did you pay off the $30 million loan with the $47 million, or is it, or was that a different pot of money that paid off that loan?
Thanks for the clarification. That's very helpful. So because of the magnitude of the $47 million, it did provide additional reserves and liquidity such that we could pay off the loan to avoid the future interest rates. So it provides for cash and liquidity to pay off the loan, even though it's not in or out of, per se, the number.
So were the so the 40, so the loan, so what pot of money was the loan paid from? How's that?
It comes out of member reserves because when we took the loan, we put it into member reserves. So when we paid it back, it came out of member reserves.
Okay. And the 47 million went into member reserves as well.
Correct.
But then then the 30 million came out of the member reserves that the 47 million went into.
Correct.
Okay, thank you.
Okay, thank you, Ms. Green. Appreciate it. If you could obviously please stay with us. And we'll move now to DFR. Commissioner Sampson.
I'm
Here
here.
with us? Okay. And Mr. Lucier. So I'm going to swear you both in together, if that's all right. Do you solemnly swear, or sorry, that's the old language. Do you solemnly affirm that the evidence you shall give relative to the cause now under consideration shall be the whole truth and nothing but the truth under pains and penalties of perjury?
Do?
I do.
Okay, are you the one who's gonna kind of lead this, Commissioner?
I will, and if it's okay, I think if we bounce back answers between, or bounce between Jesse and I with answers, depending on how detailed the questions are, as opposed to having separate testimony from me and then Jesse. Does that work?
Yeah, that works. Thanks.
Okay. All right, so I just have some recently prepared statements, somewhat informed by this morning's testimony, and then I'll just take questions on the opinion itself that I'm sure you've all had an opportunity to review. The most enduring way to favorably impact the cost of health insurance in Vermont is to address the cost of care. I applaud the Green Mountain Care Board for taking very bold and proactive steps to address the cost of care, and it is clearly visible in the more moderate rate increases we've seen in recent years relative to other states and relative to the history. DFR believes our department and insurers themselves also must be more aggressive in driving affordability and cost of care improvements. So I don't make these statements about Green Mountain Care Board's success with their regulated community to mean that, you know, it's all on you. I think all stakeholders need to be moving in this direction. Our solvency opinion summarizes the troubled history of this market, and Lewis and Ellis reference it as well in their letter. Affordability gains that result in insurer losses risk driving insurers out of the market. They risk failing to attract new insurers into the market, and it drives the need to restore those same losses in later years to ensure that insurers remain financially solvent. This type of affordability risks providing fleeting discounts, only fleeting discounts that are then followed up by price hikes. With well over 90 cents of every premium dollar going to patient care, Blue Cross is serving its members at PMPM costs significantly, and I'll quote, Lewis and Ellis, better than the typical health plan. Lewis and Ellis shows Blue Cross at the 23rd percentile for per member per month, which is the only measure that I rely on. And as earlier questioning honed in on, percentage of premium is really not a good way to measure that because there's such a wide spread of average premium across the country. So per member per month, I think, is a good measure. And even by that measure, Blue Cross is in the most efficient quartile per L&E. And this is really noteworthy given the small size of Blue Cross and its limits in reaching efficiencies, economies of scale that I presume many or most of the carriers in that exhibit provided by L&E enjoy. Board Member Walsh asked a really important question related to how much risk of uncertainty Blue Cross customers should bear. It introduces a concept of whether Blue Cross needed to be pre-funding this uncertainty in premiums or whether it should be managed, this uncertainty should be managed as it unfolds, presumably through Blue Cross's surplus. To me, pre-funding means pricing that risk into the rate request. And this is a foundational question and gets to the core of the dilemma that the care board faces in these difficult decisions. As Member Walsh analogized, this isn't like weighing a stone where there is a definitive right answer as to the appropriate level of risk to accept as an insurer versus build into the prices. Rather, how much uncertainty is in the rates is a highly educated best guess, and we've been hearing a lot of that this morning, leaving regulators only the choice of increasing or decreasing the risk that a premium has inappropriately pre-funded the level of uncertainty. Unfortunately, we are painted into a corner, and that's really all of us, with regard to this question, where the company's current capital level is not sufficient to absorb the level of uncertainty that clearly exists in this market. So they must pre-fund or price into the rate more of this uncertainty than they otherwise might have because their downside protection is not as robust as it needs to be, that being their surplus. We need to get out of this corner that we've painted ourselves into. If Blue Cross Blue Shield were to be firmly within its capital range, the CTR request from BCBS-VT would certainly be lower, as they would be willing to absorb more risk outside of their rate. DFR would find itself in a position to perhaps provide the board with an opinion that a filed CTR was unnecessary relative to the company's current capital, if that CTR request was in excess of that necessary to ensure capital kept up with trend, as was also discussed this morning. And the Green Mountain Care Board would certainly have much greater comfort in introducing some additional risk into the filing through downward adjustments. Again, it is my belief that affordability derived from insurer surplus, even unintentionally, will never create lasting affordability. Please take a moment to join me in a hypothetical future. DFR would like to see all market participants feel confident they are entering a line of business that has a reasonable likelihood of contributing appropriately to their financial strength or even breaking even. This market has not performed anywhere close to that hypothetical future. In this hypothetical future, these participants would truly want to earn more members, and so they would compete aggressively with each other on price, even at the increased risk of burning a little surplus with low or no CTR. Only then might we have a chance of introducing a third or fourth participant into the market, and along with it, even more price competition. In this hypothetical future, the Green Mountain Care Board can have a much greater comfort that downward movements in rates run a very low risk of pushing a carrier out of the market or near the brink of insolvency. Right now, given the history of losses in this market, I truly wonder sometimes whether each participant actually wants to win significant market share from the other. Maybe a little bit here and there, but I do wonder that, and that's absolutely speculation. But I think it's important to think about. So from an affordability perspective, the worst case scenario, and also the very unlikely scenario, is the Green Mountain Care Board approves this rate as filed. Blue Cross actually hits or even exceeds their CTR, returning them close or perhaps even into the target RBC range. Again, this would be the worst affordability scenario. You failed to reduce the rate that you really could have. What would then follow would be a 2% CTR request in the following years. That's what I would expect to see as their solvency regulator around that. As Ms. Green testified earlier, that's a varying number, but generally in the 2% range, you can maintain your capital position and growing trend of the book of business. So from a market stability and solvency point of view, the opposite, the worst case scenario is a repeat of recent history, which we don't need to really hypothesize because we've seen it happen, where the rate is cut without being found unreasonable or excessive. And on top of that, consistent with almost all prior years, the company has also failed to accurately predict claims. And the company once again finds itself in financial distress, which requires a 7% or even greater CTR in the 2028 filing and maybe in continued increased CTRs in subsequent filings. And if that happens again, what we would expect to happen again, in the meantime, DFR is again breathing down their neck with data requests and action plans. Consumers may lose confidence in companies and regulators alike, and the company can't make much of the needed investments in data capabilities, negotiation aggressiveness, quality of customer service and provider service. So I don't think that really helps consumers either. So we need to get out of this cycle of running our car near empty all the time and get to financial stability for all players in the market and market stability. With that, I'll take any questions on the solvency opinion.
Okay, let's start questions with Blue Cross. I don't know if it's Bridget or Mike.
We have no questions. Thanks.
Okay, Mr. Schulteis, any questions from you?
We have no questions.
Okay, and I'll go through the board members. The order this time will be member Teachout, and then Holmes, Walsh, and Merman. So member Teachout, do you have questions?
I do, thank you. I had the one question that I said earlier, so perhaps you heard it, but I'll repeat. In your solvency opinion and in the binder, it's Exhibit 16, page 4, the very last sentence. You say DFR estimates approximately 0.5% of the filed 5% CTR will serve to increase RBC closer to the target range. My question is, does this mean you're saying that 4.5% is necessary to maintain CTR levels with healthcare cost growth?
Yes.
Okay. I guess I'd love to follow up. Is that because of the volatility or because of the trend, the medical cost growth trend?
I attribute about half of that remaining 4.5% you cited, half of that to maintaining RBC to keep pace with trend, and half of that being kind of that contingency, which I speak to in the opinion. So that is how I kind of broke down this 5% request. And that was informed by very much the contingency piece, very much by kind of an objective mathematical view of how this market has performed for Blue Cross since inception.
Okay. And do you expect that to continue in the future, or is it particular to the 2027 plan year?
I haven't seen anything that would tell me that we can expect different results in terms of the volatility and lack of profitability in this market. So I expect it to continue until some, wonderful thing happens, which could be an expansion of the market, additional insurers in the market, a change in the cost side of things that's measurable and bankable.
Okay, great. That was all my questions. I appreciate it.
Member Holmes? You're on mute, Jess.
Sorry. Better? Sorry. Good morning. No, good afternoon. A couple quick questions. In your analysis, which it sounds like, has some mathematical components to it, Did your in your analysis, did you assess whether 5% CTR for each market is optimal? In other words, better than 4 or 6, or it's appropriate and reasonable?
How would you define optimal?
Well, I guess that's what I was going to ask you. Optimal means this is the point estimate that should be in the filing versus one of many options that could be in the filing. Reasonable range. So asking about a range or a point estimate? A point estimate suggests
I
that
guess
it's optimal.
the best answer I have is I really didn't think of it in those terms. So I need to chew on that for a little bit.
Okay.
In terms of like, did I find it to be optimal? Yeah, I didn't think of it that way.
Okay. That suggests that there could be another CTR that could also be reasonable and appropriate. Yeah.
Yeah, it does.
Okay. If there is more volatility in one market than the other, say individual versus small group, should the CTR reflect that additional risk, the higher risk in one, lower risk in another?
I think ultimately that's the purview of the judgment and of the filer, how they want to reflect that. I look at these markets as performing similarly. I did hear that the Q&A on that topic. The way I looked at this is that there's very little margin above volatility or uncertainty, the historic uncertainty in the market, and the need for maintaining RBC. There's not a lot left there. So that even whether that's optimum or not.
But it sounds like then most of the CTR that you see in your mathematical analysis is based on volatility and contingency for risk mitigation. And it also sounds like there are different volatilities with each of the markets. So it should suggest that there may be different optimal CTRs associated with each market.
There could be, but I think I would still land in the same place at 5% in terms of finding whether I would find what I believe to be the probable actual contribution or increase in RBC within each block of business to be more than is reasonable given affordability. I don't have an affordability mandate in this opinion, but I, of course, care about it and would point out if I found something that seemed to be just unnecessary and unreasonable in terms of the pace in which they were aiming to rebuild surplus. I would point that out.
Okay. I assume some of my colleagues may have additional questions on your letter. I want to switch gears a little bit. In your letter to us regarding the Vermont Basic Plan, you made clear that 33 VSA 1806 establishes DFR's regulatory authority over ensuring that QHP plans meet certain standards for network adequacy and cost sharing. Is that right?
I don't have that letter in front of me, and the legal analysis that was kind of part of the appendix was written by our legal staff.
I guess, is network adequacy and cost sharing in your purview as it relates to QHP plans? Is that in DFR's?
Network adequacy certainly is. I believe that's in 90-1 in our reg 90-1.
Fair, that's fine. So I guess what I wanted to ask you about in this regard is network adequacy for the QHP plans. And this came up, and I'm just curious how it applies here at the federal government level, right? The federal government is setting standards of 15 days for primary care, 30 days for non-urgent specialty care for the federal exchanges. So I'm wondering, what are the specific wait time and distance standards that DFR uses to ensure network adequacy for the QHP plans?
Can you tell me how this is relevant to this hearing and to this filing?
Sure. I think anything relevant to the QHP plans is relevant to this particular filing. And I will get to my questions in a second about how network adequacy standards are applied, but it certainly is impactful on the subscribers who are buying QHP plans, whether they have access to physicians in a meaningful way. So if that's something that you
But
regulate.
Are we doing a hearing on network adequacy, or am I testifying to my solvency opinion?
Well, I will leave it up to our hearing officer, but to the degree that patients can't get access to primary care doctors or specialty care doctors, and they have to go out of network, that impacts their cost sharing, that impacts their experience in this market. So I'm trying to understand that. It was a curiosity to me when I read your letter, so I'm trying to learn more about it here as it applies to this particular market.
When you read the letter on the withdrawal of the basic plan, not my solvency opinion.
Right, yes.
Yeah, I think this is not the reason I'm here today. If we want to have discussions with the care board on issues of jurisdiction or what we consider to be appropriate cost sharing regulation, network adequacy, we should definitely have those conversations. If there are questions from the care board, I really don't think I don't see the tie into solvency or the solvency opinion or the CTR. And you can obviously inform me if I'm missing it.
Okay, well, I think it's relevant to the QHP plans and what people are buying. And so I'm curious, honestly, this is a genuine question. I didn't know if there were standards for network adequacy that applied to these plans. We have to consider access and a whole bunch of, parameters when we're thinking about rates. So to me, I'm trying to understand access and how it's regulated by DFR here. And so
Yeah,
it seems to me you are the
90-1.
right.
Yeah, I think I'm the right person to ask. I do believe this is the wrong forum, but 90-1, I believe that's the regulation that is a bear to get through and will put you to sleep. But I think will give you a lot of insight into how DFR looks at those issues. And I'm sure there are more. If they're not elaborated in the appendix of that letter that you reference, certainly give us a question, preferably in writing, and we can respond, or we can have another meeting about those type of questions. But again, I'm failing to see the tie into this meeting or to this hearing and solvency and CTR, in my opinion.
Okay, well, I will end my questioning. Thank you.
Thank you. (903). I just got corrected. 903, not 90. I might have given the unfair claim settlement practices for property and casualty insurer regulation. That's also a big one. It's Rule 903.
Board Member Walsh, do you have questions?
Yes, thank you. Commissioner, I appreciate your solvency opinion that you sent with us. I take those, and in your opening statement, I take solvency concerns very serious. And so my questions today are about how the board should integrate those concerns along with L&E's recommendation, Blue Cross Blue Shield's inability so far to provide an end of the year RBC projection, and our responsibility to consider affordability. So my first question, you cautioned against reducing rate components absent actuarial support. So would you distinguish between an unsupported policy reduction and a rate modification based on L&E's actuarial recommendation? Do you have a distinction between unsupported policy reduction and modification based on actuarial recommendation.
If I read the L&E opinion accurately, and that's a big if, I see them recommending reductions, not because they found the utilization trend to be excessive or unreasonable. I don't think they said this is unreasonable. They compared it to others. So they did a market comparison and then recommended a lowering of it, if I remember correctly and if I read that correctly. To me, the way I view the importance of adequacy of rates, that reduction merely increases the need for a contingency in the CTR. So, and I think that's somewhat supported by page 23 of their individual opinion, which is Exhibit 14, where they say reducing premiums by 1% has the same effect on RBC, whether it's effectuated by reducing the CTR assumption or by modifying any other assumption. So just because something is still reasonable, history in this market shows us that these reductions that are not driven by a finding of whatever the proper term of art is, excessive, unreasonable, they just don't pan out. They don't match reality. And again, that is a contributing factor. And I don't want to say that it's just these reductions that have led to the cumulative losses of both carriers, because the driving factor behind that has been their inability to properly assess and price the volatility and uncertainty in this market. It then gets compounded by rate suppression that I believe is inappropriate, given the need, the beautiful hypothetical future that I think we need to get to in terms of a market where participants can predict at least a 50-50 likelihood of getting a return on investment in any given year.
Do you believe that the rates resulting from L&E's recommendation would be inadequate, or they'd fail to protect solvency?
They would increase the risk of inadequacy and increase the, I mean, nothing, as you said, I think quite eloquently, this is not measuring a stone. This is all, and even in the L&E opinion this year, this new kind of bell curve of potential outcomes, hypothetical potential outcomes, that's the world we're dealing with here. Yes. Is not yes, no, so much until it crosses a certain threshold. I mean, that's when something is excessive or clearly inadequate. An actuary will certainly tell you that's their professional obligation. And from the solvency point of view, although it doesn't look like it from the history of our opinions, but that's more a condition of the market and its lack of profitability. But we will tell you when we think there is what I would call an unnecessary or uncalled for contribution to surplus that's not justified by capital position or volatility. We will tell you that.
I appreciate that. Earlier this morning, Blue Cross stated that producing a year-end RBC projection was too uncertain. It seems to me that a lot of insurance work is making estimates in the face of uncertainty. So how should we evaluate a solvency-based request for 5% CTR if the carrier can't provide an estimate of its end-of-year RBC?
End of year 26 or 27 or both?
Both. Thanks.
Well, right now you're looking at QHP rates, individual and small group, very much the driver of the denominator of RBC, as my opinion discusses. But there are also a lot of factors outside of, gains and losses outside of the QHP that would go into an RBC estimate. I think for me, the most important takeaway from the discussion of projections of the fund. So RBC reflects the company's total financial results and total risk. I support the comments of Blue Cross and the some of the bell curves provided by Lewis and Ellis. I would caution the board putting too much weight in interim numbers and projected numbers that rely on a starting point, which would be 2026 year-end RBC, that is far from certain. Internally, we looked at, as part of this analysis, we looked at the history of RBC, and I think this was actually mentioned by Ms. Green. We looked at the history of RBC projections that were provided in prior filings relative to where those numbers ended up. And that is not something that would give you any confidence, or I think should give you any confidence in relying on that almost in any way, directionally at best. And I'll tell you, directionally, their RBC is improving. I expect it to be higher at year end, but I would be a fool to give you a number because, as you know, and I'm sure you've heard in prior testimony, there's a large amount of seasonality in claims development. And as we see in the history of this market, not just for Blue Cross, but for both insurers, there is a very large amount of volatility that I don't see the value in it.
So if I'm hearing you correctly, the RBC projections are too uncertain to rely on, but the solvency justification for a 5% CTR, that projection is more certain.
Well, actually, it's the same. Because of the variability, you need the CTR, and because of the current capital position. So it's not like those are an opposing approaches.
I see. And is it your position that the uncertainty that we've been talking about with these calculations, that should generally be resolved in favor of the carrier, or that should be weighed alongside affordability and other factors?
It should be weighed between affordability, for sure.
How should the board decide how much uncertainty should be borne by the carrier versus by ratepayers?
I think you have the kind of the real life examples in front of you in terms of having lived through, I believe, I rejoined DFR a little over a year ago, but I believe you were part of the care board during the journey, we'll call it, of Blue Cross's financial struggles, which of course DFR had a front seat to as well. So of course that is a very fresh wound in terms of understanding how to weigh the importance of solvency versus affordability, as is the need to rebound to a 7% CTR. But I also think that judgment of how to weigh that, it is just like the actuarial assumptions within the filing is a risk-based judgment that the board takes. And it is a judgment. It's not something that can be entirely predicted with math. We all try to put math around this. We have to put something around it.
Yep.
And it's different for each carrier. Each carrier has a different history, different level of exposure. Blue Cross happens to have a very high level of exposure to this line of business. They are a single state writer. They are not authorized to write outside of this tiny state. And that is a very material factor in their need for surplus and the target range that has been established.
So, I guess just one more question then. I understand, and I think we agree that claims are the main driver of premiums, and bringing the prices behind those claims down is the surest way toward lasting affordability improvements. Our statutes require us to consider affordability even in this process. And I'm wondering what you would consider, what evidence should the board use to decide whether Vermonters' exposure to these rate increases, whether that's affordable? What's your view on how we should assess affordability?
I think you're asking the right questions. I don't have a formula or a definition for you. I think understanding the history of this market is very informative, and that's why I focused on that in the opinion, and really understanding that. I guess the number, I don't have a framework for you or definition, but I'll tell you that I would caution against seeing the 5% as a profit margin. It is not a profit margin. History almost proves that. There's been a handful of years where they've outperformed the expected CTR. The overwhelming evidence is that both carriers will underestimate. Maybe they're being really competitive. I don't know what's going on, but and I've talked to the carriers about this. So again, I guess the only response I have is you're asking the right questions. I respect the difficult balance you have to achieve, but I would caution against being tempted into thinking a 5% CTR means a 5% profit margin, because it really doesn't. It's not how it was filed. It's not how it was put together per Exhibit A of the filing. And it's not how we view it. And history kind of bears that out.
I appreciate that. And it's, as one board member, that's not how I look at it. I'm trying to look at, with so much uncertainty involved in this type of math, and these type of factors, who should bear how much of that uncertainty?
Yes.
Yeah. So I appreciate your letter. I appreciate your time today. Thank you very much.
Thank you.
Board Member Merman.
Hi, last up. So thanks again. I guess just to pick up with a statement that you made there, I too find the history of this market quite interesting and compelling, and have been trying to understand it. I think one of the most helpful tables in all of that is a table in the filing that you pretty much, I think, essentially reference in your letter, which shows this actual contribution to reserve has been less than the filed or approved contribution to reserve for most years. I don't have I believe it's table 2 or 3, but either way, I think we don't have to speak about it in specifics this time, but and I do think that this market has, I think, as you mentioned, has not performed well, and I see that. So I'm trying to figure out what analysis has DFR done to try to figure out why this market has struggled so much.
I mean, the first thing that comes to mind is just the lack of size. 30,000 members in each pool, approximately. I recently read something from maybe towards the beginning of the ACA and the setting up of exchanges that kind of set an actuarial rule of thumb in a paper of 100,000 lives for more stability. So the volatility absolutely is inversely correlated to how many lives you have in the pool. So that, I think that's a major factor. I think we've also had a lot of Yeah, I'll just leave it at that. I think the size of the pool is probably the biggest driver of its volatility. But your question was specifically, what have we done for an analysis of the market? You know, I think obviously we're concerned with the flight of younger folks out of the market. This is not to stray off of the topic of this hearing. This is why we are exploring age rating. It's also a very skewed, the market itself with almost 80% on the individual side receiving subsidies, some of them so significant that they don't see or feel everything we're talking about today. I think that creates weird behavior that probably makes this market not behave the way some insurance markets would.
Okay, so, and those are like performed analyses or kind of thoughts and opinions of what you think probably is leading to it.
Thoughts and opinions.
Okay.
But we are looking
that
at,
way I won't ask you for the analysis then if it's not.
Well, I do have let me give you a better answer that more recently we've been inquiring of insurers to get a uniform understanding of but it's not just in this market, it's not just in QHP, but statewide utilization trend, regulated and unregulated, and medical pharmacy price trend, just to understand from how it lands on insurers what they're seeing. And that includes the ASO market or the major players in the ASO market.
And I guess that's what I'm trying to get at is, do you know what the medical, the drivers of the medical trend have been in Vermont? You implied that claims costs are exceeding premium, so that it would seem that if claims costs are exceeding premium, that it would be a medical trend that's driving it, maybe pharmacy trend as well.
So what we've heard is from our regulated community is what you heard earlier today, that outliers are in both utilization and unit cost of diagnostic imaging and labs.
Okay. So, and you mentioned in your opening remarks that this is really like a cost of care issue in Vermont. I guess one thing when I look at this, you know, I see year after year medical expenses exceeding expected, known high price outliers. Could an insurer generate a contribution to reserves if they could negotiate for lower prices?
Yeah, but yes, but that would leave them in a similar dilemma you'll have later in the summer, which is your regulation of prices versus the ability, the financial stability of your provider community and customer, and to Member Holmes' question, access, quality of care, network adequacy, all of that. But yeah, if insurers, yes, if insurers or the care board or popular, opinion causes or utilization or change in behavior causes the price of care or the utilization of care, whatever the source of that downward pressure, would be the most impactful thing for insurance premium cost.
I haven't done this regulatory work outside of Vermont, so I'm sort of making an assumption, but my assumption is outside of Vermont, often an insurer sort of plays sort of the natural tension with the provider to negotiate over prices, to try to keep prices lower for the public to be able to have more affordable health care. In Vermont, we have this regulated system, but there's still the ability to do that. In fact, I think we saw that this year. Do you think it's appropriate for insurers in Vermont to try to negotiate for lower prices on their products?
not only appropriate, I think it's a mandate. I think they must. And, but to that point, or to that question, Vermont is such a almost monopolistic state in terms of competition, certainly in the hospital space, competition in the areas of high price like imaging and labs, or lack thereof, I mean, and lack of competition, meaningful competition in the fully insured market. So a lot of those dynamics that would take the load off of the work of the Green Mountain Care Board, or DFR to compel insure, that probably does not exist, almost very likely doesn't exist in most other states where you have, where consumers have quite a bit of choice among competing insurers. Insurers can actually walk away from a hospital network or a major provider organization. These are, to be more black and white than I should be, they're just not, it's not possible in Vermont for one of the major players to negotiate in a way that they could act. You have to actually be able to walk away, and the other party has to believe that. And that's neither the case for hospitals or insurers in this state. It just isn't.
So if, say if there's a year where Blue Cross has a bad negotiation year and they end up paying 25% higher commercial prices than they expected, should they then, what should they do? What's their responsibility to do for the next year's for the next year? Should they raise premiums up to that 25%? Should they renegotiate down? Should they, what's the solution to that failure?
If they had, I'm sorry, the source problem was they had they did poorly in a negotiation, ended up paying 20% more than they thought, or okay. They should, I think, do all the above. I mean, they have to cover their actual costs. And if they did a objectively poor job, if management and the negotiation team did an objectively poor job negotiating that, then their board of directors should be involved in saying, what the heck's going on here, people? But there's also a responsibility on the side of, in Vermont, where we have nonprofit this and that across the board. You have nonprofit provider groups that have the same obligation to serve Vermonters as opposed to maximize their profit. So, the same comments I'm making about what the board should be saying to the insurer has to happen on the other side. And this is probably why you and I, as regulators, have both gotten involved in the negotiation space, is through pressure, but also in the care board's purview through actual price and revenue control with escalating authority or tenacity, is because we've created a dynamic, or we've been created it, I don't know. There is a dynamic that it's not happening, that the individual players are somehow unable to get there through private negotiations. And it could be that the lack of the ability that everyone needs each other. They can't walk away. So at a certain level, they feel powerless and rely on regulators perhaps to set the price environment.
I think one of the challenges for us is one way to potentially empower an insurer to negotiate harder is to constrain the rates, because the provider is reliant on the payer, and there's this interrelationship. But I guess when I read your opinion, when I look at the history, it seems to me that we've had higher than expected medical claims costs, pharmacy claims costs, and that multiple years of hearing difficulty with negotiations, challenge with negotiations. But the solution in the letter feels like, well, then we should just add CTR. But it seems like the problem is actually on the pricing side, not on the additive CTR side.
Yeah,
Is that something?
I agree. The problem is on the 90 cents or north of 90 cents that make up these premiums. I think there's shared responsibility on how the cost of care has gotten to where it is. What I definitely disagree with, though, is that an approach of setting a known inadequate or high risk rate, I won't use inadequate, a higher risk rate, and then expecting an insurer to negotiate accordingly. I think that's been tried and proven not to work. Doesn't mean we can't change the dynamics to make that work. And we've actually thought about that internally at DFR. Are there different things we need to do to, is the balance off in terms of who has the power in a negotiation? And are there things that can be done by statute to tip that balance in favor of consumers? And I don't know if this is the place to go into some of those ideas, but I'm more than happy to share them with you. They have been shared with your chair during the session in terms of different statutory approaches to empower insurers to have a little more, whatever it takes to demand prices. But
I think it's a good discussion to continue on. So
I agree.
Yeah. All right. Thank you. That was, I know, a long version of this, but thank you.
Thank you.
Okay, so I think now is the time to do a non-public session. Just to go over the mechanics of that. In the past, the board has voted to go into an executive session, and I think there are many references today to executive session. I don't think legally an executive session is required for reasons I explained last year, but essentially the board statute was changed a few years ago now to say that notwithstanding the open meeting law, the board can examine and discuss confidential information outside of a public hearing or meeting. So executive session is a kind of construct of the open meeting law. I think you can just vote to go into a non-public session to examine and discuss information that is confidential. Obviously, like we covered at the beginning, the confidential information in the exhibit binders is the kind of highlighted material. There appear to be questions about that. And if there's a need to discuss confidential information beyond that, we can tackle that. But that's how I would prefer to deal with it. Would any board member like to make a motion to go into a non-public session to discuss and ask questions about confidential information?
Sure. I move that we go into executive session, non-public session to discuss and evaluate confidential information related to Blue Cross Blue Shield 2027 QHP rate filings.
Second.
Okay, all those in favor, please say aye.
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 Okay, and just before we go off the record and go over to the other line, want to just give folks a time frame for when we might expect to be back. I didn't hear a lot of questions, so I don't think it will be very long. I'm going to say half an hour. Tara and Kristen, if we could, when we put up the information on the public session screen here, if we could just have half an hour and then we can update it kind of as we go along. The participants in the non-public session, so the Blue Cross witnesses and attorneys, healthcare advocate attorneys, and Mr. Fisher, obviously, Green Mountain Care Board members and staff, LNE, DFR, The court reporter. I think that is it. Any questions before we go off the record and move over there?
Can we do a 10-minute bio or 5-minute bio break, Chair Barber, before we start this?
Yes, good call.
Thank you.
Okay, Angela, could we go off the record, please?
Sure, off the record, 206.
And I'll see everyone over on the executive session line at 2:15. Does that sound good? Okay, thanks. All right, I see all the board members, but Dave, are you with us?
Yes, sorry.
That's okay. Um, Blue Cross, I'm seeing Bridget, I see you, but I can't, I mean, your camera's off. Oh, there you are.
Hi, Mike, I'm back on, but I think Mike D'Onofrio's handling the next witness.
Oh, okay. I'm not
Yep,
seeing Mike.
I'm here. Can you hear me?
I can hear you. Trying to find you. There you are. I have to pin people on my screen, so it
Yeah,
takes
I'm
me a
doing that
second.
now too.
Okay, and I see Laura, I see Kevin, Eric, I think we're all here. All right, so why don't we go back on the record, Angela?
On the record, 253.
Okay, and the next witness is Kevin Rugeberg. So Kevin, I'm going to swear you in. Do you solemnly affirm that the evidence you shall give relative to the cause now under consideration shall be the whole truth and nothing but the truth under pains and penalties of perjury?
I do.
Okay, Ms. Bellavo, go ahead.
Great. Can everyone hear me okay? Few nods. Kevin, can you hear me okay?
Yes, yes.
Great. Could you please state your name, position, and place of employment for the record?
My name is Kevin Rugelberg. I'm a senior consulting actuary with Lewis and Ellis.
Great. And you have submitted reports for the individual and small group filings in these proceedings, right? And they're exhibits 14 and 15.
Correct.
Do you have any changes you wish to make to either report at this time?
Yes, unfortunately, I do. So on page, I believe it's page 6 of the small group report, that's exhibit 15, there's a heading that is repeated. So it says change in trend from 25 to 2026. That is heading 2 and 3, I believe. The latter of those should be trend from 26 to 2027. I think most people will have figured that out, but just clarifying. I also, more substantively, page 8 of exhibit 14, and then a similar page in exhibit 15. The third bullet says the large group block which did not experience a material decline in enrollment. That phrase is not accurate. What I was intending to communicate and did an extremely poor job of is that the trend exhibits in that filing are able to isolate a population which did not experience a material trend over that time. It is not the case that that block did not lose members. So I just wanted to make clear that we understood that point, and it doesn't shake, like we were understanding of that point when we made this bullet, and it's not that our claim is contingent on that apparent misunderstanding.
Great. Great, thank you. Now you, anything else to correct in your reports?
No.
Great. And you also have submitted pre-filed testimony, which is exhibit 21 in the binder. Is that right?
Correct.
Is the information in your pre-filed testimony accurate and correct to the best of your knowledge?
Yes.
Is there any information you would like to change or clarify at this time?
No.
And do you wish to adopt this pre-filed testimony as part of your testimony today?
I do.
Can you explain your standard of review in both filings?
Yes, we review the rates for whether they are adequate, not excessive, actuarially sound, and not unfairly discriminatory.
Uh, do you review for affordability in your filings?
We do not.
Do you review for whether the proposed rates promote quality care or access to health care?
No, we do not.
And do you review for whether the proposed rates protect insurer solvency?
Only insofar as that is a relevant question to whether the rates are inadequate.
Thank you. Do you review for whether the filings are unjust, unfair, inequitable, misleading, or contrary to the law?
In some cases, whether they are contrary to the law, but not the entire scope of that, no.
And have you reviewed the carrier's pre-filed testimony, reviewed all the materials that have been submitted so far in these proceedings, and listened to the testimony today so far?
I have.
Now, am I correct that your reports each contain 5 recommendations?
Is it? Sorry, I thought there's one less on small group because of the
Oh,
catastrophic.
okay.
It might be that that's an error in our report. Let me
Okay.
check really fast here. Oh, no, it is 5.
It is 5.
Now I'm confused. Just a moment. Oh, okay, I see. Number 3 in the individual is sort of a compound recommendation. So they're slightly different, but it is the same number. Yes.
Thank you. And of those recommendations, did Blue Cross and Blue Shield of Vermont disagree with any of those recommendations
They did.
regarding the medical utilization trend?
Correct.
Yeah. Can you please discuss your recommendation to revise the medical utilization trend and your understanding of the carrier's disagreement with that recommendation?
Yes. As always, we have to review the trend with sort of a holistic view to all of the information available to us. We understand that Blue Cross is very concerned about the 5.2 number that they referenced earlier today, the utilization trend in the most recent year. That said, had trend been set, in that exact manner, just using last year's, I would have been very wrong in most years. It has fluctuated quite substantially over time. And that's one of the reasons why we think it's important to look not just sort of at the market, but at this market as a whole, but also more broadly, longer term industry trends and looking outside of Vermont potentially. So there's also the problem of the numbers that they're reporting do not consider the potential that the morbidity of the covered population has changed during this period. And in fact, we have good reason to believe that it has. So the risk score, I believe the numbers has increased by approximately 15% over the 3-year period in question. That is itself about a 5% per year change. We have no inclination to suggest that that can be used naively to simply subtract from utilization trend. But it is indicative of there being membership shifts that ought to be considered when we think about this assumption prospectively. Yeah, I think that's what I'll say on that point for now.
You heard testimony this morning regarding the 2025 loss ratios and significant claim losses. And I wondered if you had any comments about the 2025 loss ratios and claim levels.
I do. So what we say in our report and was quoted this morning is that the loss ratio, sorry, I'm trying to read the exact phrasing. The actual QHP risk-adjusted loss ratios were generally consistent with the projections in those filings. So that claim is based on the URRTs. We used the final ordered URRTs from the 2025 rate filings and calculated that when you combine the two markets together, you get, I believe it's an 89.0% loss ratio. When you then look at the URRTs in this year's filings, and they report the risk-adjusted loss ratios for 2025, you get an 88.7, which is actually slightly lower. Now, that doesn't account for the updated risk adjustment figures that Blue Cross was not aware of at the time they produced those URRTs. Combined across the filings, that increases the loss ratios by, my understanding, is about 0.3%. So you add those together, and there's some rounding and some nuances that I can't quite perform without their help, but I get about 89.0 projected and 89.0 actual. So I continue to believe that the statement there is accurate. Now, I understand that when you look at CTR, you get a slightly different picture. But CTR, CTR coming out worse than expected can result from non-benefit expenses and other things that have no relevance to trend here. So I'm not sure I understand why, a claim about loss ratios would be disagreed with on a basis that is not loss ratios. I remain a bit confused on that point.
Okay. So I'll move on unless you have more to say on that topic.
I do not.
Great. And just, did you review the carrier calculation prepared by Blue Cross and Blue Shield of Vermont's actuary, which is Exhibit 22?
I did.
Can you explain what that calculation represents?
Yes, my understanding is that they are calculating what the sort of principles and recommendations that we put forward would actually result in on the rate side. Unfortunately, we attempt to approximate the actual premium impact, but there's various pieces that are a little bit outside of what we can do without access to the actual pricing models on their end. So regrettably, we were farther off than usual this year, but I have no reason to doubt that their figures are an accurate representation of the premium impact from our recommendations.
Thank you. So is there anything you wish to add or change to your recommendations for the individual and small group filings reflected in your reports?
No.
Okay. And if all of your recommendations were to be implemented, what would the projected rate increases be?
Based on the carrier calculation, 3.6 for individual and 2.1 for small group. I'll note that that does not include updated information from hospital budgets. I would estimate that that changes it to about 5.1 on individual and 3.2 on small group. But again, to the extent that that disagrees with figures calculated by Blue Cross, I would defer to their exact calculation.
Okay. Do you find the increases that you've just stated in the individual filing and the small group filing reasonable from an actuarial perspective?
I do.
Can you tell me why you find it reasonable?
I believe that it produced the rates would provide, adequate revenue to cover reasonably expected expenses and provide a reasonable contingency for adverse events.
Okay. Thank you. That is all of my questioning.
Mr. D'Onofrio, do you have questions?
I do, thank you. Good afternoon, Mr. Ruggeberg.
Good afternoon.
Good afternoon. I'd like to ask you a few questions about the medical utilization trend and a few questions about your analysis of the CTR. And I'll try to move us through that as quickly as I can this afternoon. So the medical utilization trends are addressed in Exhibit 14 and Exhibit 15 at pages 7 to 9, correct?
I believe that's correct. I'll trust you rather than flipping back to the small group report.
And as far as you're aware, it's the treatment of that element of the rates is identical in the two documents, right?
Correct.
So if we look together today at Exhibit 14, that kind of covers our bases, right?
Yes, yes.
Okay, so if you wouldn't mind turning to, let's start at page 8 of Exhibit 14, please.
Okay.
So L&E compared the range of medical utilization trend assumptions used by other carriers in the individual and small group markets nationally against Blue Cross's selected assumptions, correct?
Correct.
And you did that by analyzing something called the public use files. Is that right?
Yes, yes.
Can you explain what the public use files are?
Yes. So any premiums to be offered in the QHP markets have to be accompanied by what's called a Unified Rate Review Template, the URRT. That's a standardized data collection form mandated by the federal government. It requires insurers to basically decompose their proposed rates into different explanatory variables, right? So what is the base period experience? What are anticipated changes in morbidity? What are anticipated changes from population changes? All of these pieces. One of those is utilization trend. So by looking within that database at those particular data items, we can see what the average assumed medical utilization trend was for QHP carriers nationally.
And what time period is covered by the public use files that you analyzed as part of this exercise?
We have the most recent available, which is from, it's projecting 2026 premiums. And so I'm happy to acknowledge that that's trend from 2024 to 2026.
And about how many data points are contained in the public use files? I'm sorry, let me be a little more specific. About how many medical utilization trend figures are contained in the public use files?
That is a very good question, and I regret not including that figure. I can approximate from the image that I included that it's probably about 300 to 400 that were included in our analysis. I'll note, and we might have been remiss in detail here. We filtered out, there's things like I think there's some dental in there and things like that. We took some effort to exclude the things that are less relevant. I believe we only included filings with effective dates of 1/1/26 and thus sort of excluded subsequent, quarterly small group filings. I, sitting here today, extremely regret that there's not a footnote explaining those filterings because that should have been provided. That said, it is, I believe, on the order of 300 to 400 that were in what is included in that exhibit.
Okay, thank you for that explanation. And the Blue Cross medical utilization trend under analysis here is for a different time period, right? It's trending 2025 information forward to 2027.
Absolutely.
Okay. Do the public use files give any indication of how accurate the trend assumptions contained therein turned out to be?
No, it doesn't. I have at times looked at, you can comparatively look at, we have PUF files going back to, I believe, 2014. So I have looked a bit at sort of the relationship between assumed trend in one PUF, in a prospective PUF and comparing. But in terms of does this PUF have any indication of whether those trends were accurate? No, it doesn't.
So based on the evidence in the record here, you were able to review in detail how Blue Cross Blue Shield of Vermont calculated its 2027 medical utilization trend, right?
Yes.
And were you able to perform a similar type of analysis of how any of the medical utilization trends in the PUF were calculated by those carriers?
a handful of them, but certainly because of other work, but certainly not anywhere near a comprehensive representation of them. No.
So you mentioned that you did some filtering of kind of the overall universe of information in the PUF to filter out some things that you thought were irrelevant. And I think you mentioned, for example, quarterly filings and filings in other kind of benefit areas like dental, right?
Correct.
Did you make any attempt to isolate medical utilization trends for carriers that came from states with relatively small populations like Vermont?
No, I don't think that would likely be appropriate.
Did you try to isolate medical utilization trend assumptions in the public use files for carriers from states with similar statutory benefit mandate structures as we have here in Vermont?
No.
Did you try to isolate medical utilization trend assumptions in the public use files for carriers from states with small numbers of market participants like we have here in Vermont?
No.
And did you try to isolate medical utilization trend assumptions in the public use files for carriers of similar size to Blue Cross Blue Shield of Vermont?
No.
Okay, so you took the several hundred data points in the PUF, leaving, using the filtering that you described, and you created a distribution of those trends, right?
Correct.
And that distribution is depicted by the graph at the top of page 9 of Exhibit 14, right?
Correct.
And then you noted that Blue Cross Blue Shield of Vermont's proposed 2027 medical utilization trend. Sorry, you noted how that compared to that distribution, right?
I believe I noted where it falls within it, roughly, yes.
Right. And you based your recommended modification of Blue Cross and Blue Shield of Vermont's medical utilization trend on the results of that comparison, right?
Only in part, not entirely, certainly.
I'd like to direct your attention to the two sentences that begin it's like the last few words of page 7, going over to the top of page 8 of Exhibit 14. I'll read it into the record. It says, and I quote, BCBS-VT's analysis controls for provider contracting changes in monitoring of fraud, waste, and abuse, member age, number of working days per month, and induced demand. As a result, there remains the possibility that changes in the enrolled population not captured by these factors are not fully reflected in BCBS-VT's analysis. So that's part of your analysis here, correct?
Correct.
So did you attempt to identify, so you noted the possibility that changes in the enrolled population not captured by the listed factors, those types of changes are possible, right?
Correct.
And did you attempt to identify any such changes?
Yes.
Can you explain your response? For example, what changes?
Yeah, so the first bullet we note there is that the risk score increased by approximately 15% over the period that we're talking about. Again, that's roughly 5% a year. And reading it this morning, I don't think our second bullet is terribly clear. What that second bullet is basically getting at is that the overall normalization that Blue Cross performs is not literally 0, but very close to 0, which more or less confirms that whatever is going on in that risk score is not really being normalized out. So we can say confidently that there is something which is not something very material, frankly, that is not being normalized out. Now, it is very difficult from where I'm sitting to say exactly what that is and what its impact on prospective trend is. But the naive assumption would be the Blue Cross picked up a substantially sicker population or lost their healthier population. And one way to evaluate whether that was in fact what's going on is to see whether or not their risk adjustment transfers accounted for the change in the morbidity. And in fact, it seems to have. That's one of the major reasons we reference risk-adjusted loss ratios there. So the main thing we're referencing that's not in that list is the morbidity of the covered population. And I'll note that we made pains to consider the extent to which that's impacting this analysis.
Did you perform any calculations in order to do that?
Yes, although I don't want to overstate the sophistication of those, right? I mean, if I take the, Blue Cross is reporting that approximately, I forget the numbers offhand, but the utilization is roughly that same 15% higher. I think more like 14% higher in 2025 than in 2022. If you normalize that for the risk score, which admittedly is imperfect, you get a trend of, again, roughly like minus 0.33% per year. We certainly did that calculation and considered it, although it's obviously not our best estimate. We calculated the loss ratios, and again, I regret not putting those numbers in there because there was apparently some confusion on that point. I'm trying to think of other specific calculations performed. Nothing else comes immediately to mind, but yeah, I'll stop there.
And the calculations you just described are not reflected anywhere in this report, right?
I suppose, perhaps wrongly, I thought that referencing the increase in the risk score would direct people to understand at least that first calculation that I was describing. Now, I'll note, I guess I'm hesitant to put a number like minus 0.33% per year in the report because I don't at all want to suggest that I think that that's a correct assumption in this context. So the intention here was to say we performed analyses and we think that they suggest the trend assumption should be lower than what's being proposed here. But there is no formula which output the 3.5%, if that's the nature of your question. I will be perfectly clear on that point. It is our attempt to holistically compile all of this information into what we can call a best estimate.
That kind of takes me to my next question. If I could direct your attention over to page 9, just below the graph of the distribution. The first sentence there says the available data do not point to a single clearly superior trend assumption. So, I mean, given those words and given the testimony you just gave, that statement applies to your recommended result of 3.5%, right?
Correct.
And in that sentence that I just read to you, when you say the available data, just for clarity, does that refer to the public use files that you analyzed?
It refers to everything provided to us by Blue Cross, in addition to everything we went and supplemented it with as referenced in this report.
If you could look just a couple sentences further on page 9 there, the last sentence of the second paragraph says, this assumption recognizes the high trend in recent years while also leveraging the more moderate trend indicators available from other sources. Do you see that?
Yes.
And this assumption in that sentence is referring to Lewis and Ellis's recommended 3.5% trend here, right?
Correct.
And by high trend in recent years, you mean Blue Cross Blue Shield of Vermont's actual experience in these markets, right?
their trend experience, correct.
Thank you for that clarification. And then again, for the clarity of the record, what are the trend indicators available from other sources that you're referring to here?
I'm referring to data from the other carrier in this market and the PUF primarily, as well as our general industry knowledge.
And regarding the medical utilization trend, Lewis and Ellis is not concluding that Blue Cross Blue Shield of Vermont's proposed medical utilization trends are actuarially unreasonable, right?
We did not opine that. I would say when combined with the 5% CTR, the proposed is about at the end of what I could plausibly call reasonable. But I am not today saying that I think they are unreasonable.
And Lewis and Ellis has not concluded that Blue Cross Blue Shield of Vermont's proposed medical utilization trends result in rates that would be excessive under the actuarial standards of practice, right?
Yeah, I did not opine as much.
Let's flip to page 20, please, of this document. And you see maybe a third of the way down the page, there's a heading with number 12. It says changes in contribution to reserves, CTR.
I do.
And that analysis extends over to kind of the bottom of page 23, right?
Believes that's about accurate. Yes. Yes.
And here again, this analysis is identical for the two markets, right?
Yes.
Okay, so if we'll stick with exhibit
No
14
problem.
and we cover our bases. Thank you.
There's a tiny caveat to that about bad debt, which is not in the small group, but I don't think you're going to be asking about that part.
That's an accurate actuarial prediction. So if you could turn to page 21, and in the middle of the page, there's another graph showing a distribution, right?
Correct.
And this is a distribution of contributions to reserve as percentage of premium by QHP carriers nationally, right?
Correct.
And your data source for all but the Blue Cross 2027 data point here again is the public use files that we've already talked about, right?
Yes, and I now feel obligated to point out, I believe the same filtering is applied here as in the trend case.
Thank you. And I assume that means I'm not going to go through the litany of questions I asked you earlier, but I assume your answers to those questions would be the same in terms of the filters that I proposed to you.
Almost. There's one that I'm going to revise as I remember it, and I'm relying on memory a bit here. You asked about the size of the carriers, and I said I didn't think that'd necessarily be appropriate when looking at trend. I continue to believe that's true. The size of the carriers is definitely much more relevant to CTR than it is on trend. So I would not, the answers yes, no are still exactly the same. I'm not controlling for those things. But I do think it would be, more reasonable to be thinking about some carrier specific things if anybody was to raise concerns based on Blue Cross's position within this distribution.
Got it. So just so I'm clear, for the purposes of this distribution, you did not attempt to isolate carriers of a similar size to Blue Cross Blue Shield of Vermont.
Absolutely not.
And what about because this is specific to CTR, did you attempt to isolate carriers with similar RBC results? Now if you could jump over to page 23, I'm almost done. There's a table at the top of page 23, right?
Correct.
And that table shows the results of an analysis that you performed of the distribution of potential RBC outcomes arranged by percentiles, right?
Correct.
And the 80th percentile outcome corresponds to an RBC of 564%, right?
Correct.
And just for clarity of the record, the RBCs that you calculated as part of this analysis are year-end 2027 RBCs, right?
Correct. I apologize if that's not clear from the report, but this is intended to be talking about year-end 2027 exclusively.
Yeah, no, it's very clear in the report. I just want to make sure it's clear on the record here. So thank you. So what that 80th percentile result means is that 80% of the possible outcomes would result in an RBC of 564% or less, right?
So I agree with that mathematical interpretation. I do want to clarify that this is based on the information we had at the time of our report. And also, as I think we make clear here, this is a fairly simplified analysis. We don't intend, I am not certifying that I believe there is an 80% chance, especially not today, as we sit here with perhaps updated information, that there is an 80% chance it will be below 564. But that is the correct mathematical interpretation given the model and assumptions as described in the report.
Hearing Officer Barber, could I just have one moment to consult with my colleagues? I think I'm finished, but if I could have 1 minute, I'm just going to step off camera really quick if that's okay with everybody. Thank you.
Sure.
Thanks very much, Mr. Ruggeberg. No further questions at this time.
Thank you.
Mr. Schulteis?
We have no questions. Thank you.
Next, we'll go to the board members. Starting with Member Teachout, Member Holmes, Member Walsh, and Member Merman. So, Member Teachout, do you have questions for Kevin?
Thank you. I don't actually have any questions.
Member Holmes?
Nor do I. Thank you.
Member Walsh?
Yeah, just a couple. Thank you for being here today with us. I wanted to focus with you on how we should try to understand your recommendation in light of all of our responsibilities. I think we have some disagreement between what the carriers provided to us, DFR, and our requirement to include affordability in our decision-making. And so I guess my first question, you've recommended a lower medical utilization trend than the carrier did. Is that 3.5% trend your best estimate, or is it still within a reasonable actuarial range?
The 3.5% is Lewis Analysis best estimate, I would say. I would say the reasonable range extends above and below 3.5%.
And if we were to accept that, that would be an actuarially sound correction. That's not an affordability discount or any other principled principal-based discount.
In my opinion, of course, I understand that there's at least one actuary in the world who disagrees that it would be actuarially sound. So I don't, I'm not a lawyer, and I'm not trying to opine that that is actuarially sound in some sort of universal or absolute sense. I honestly don't know how to resolve the answer to your question, is my point.
Mm-hmm. Your lower trend, you calculated that lower trend using actuarial science. It's not, if I've understood you correctly, a reduction for affordability.
Correct. And I guess actually I will append to what I just said. I believe the other actuary I was referencing testified today that she did not believe that the 3.5% with the 5% CTR would be unreasonable. So I actually am not sure what I just said is true. I'm not sure I know that there is an actuary who believes it is unsound. I overspoke there.
It's been a long day.
Yeah.
You just see. So it's not a policy discount. The rates that you're recommending would be adequate.
That is my professional opinion, correct?
In your opinion, does you do your calculations resolve the affordability questions before the board?
No. No.
Okay. Thank you. That's all.
And Board Member Merman.
Kevin, just have a few questions. When you have looked at the prior puffs, or when actuaries have reviewed puffs compared to how they end up performing in accuracy over time, are they accepted to be relatively accurate?
I don't want to represent that what we have done here is necessarily normal. What I will say is, when I have looked at the puffs, one thing I have found is, I apologize, I don't have any of this in the record or anything. I have generally found that the outlier high and low projected trends tend to correlate at least somewhat with outlier high and low actual results in the direction that would suggest that outlier trend assumptions are usually not borne out in actuality. That is to say, carriers that assume 7% medical utilization trend or whatever are likely to make more money than they projected. And the same is true of carriers who assume negative utilization trend. They tend roughly to make less money than they projected, which is to say that I think the puffs provide at least a reasonable sounding board against which data should be evaluated, right? There's the whole thing about the wisdom of crowds, or whatever they call it. Certainly, I cannot do more work than the combined efforts of all of the nation's health actuaries. And so I believe there is value in gut checking against what they're doing.
Okay. And would you have any reason to believe, through your professional experience, that small states would skew in a particular direction?
No. I'm going to be careful how I respond to that. Generally, the point of trend is to be sort of the general trend, absent a bunch of specific one-time events and things like that. I think there's troubling tendency among some people to say, well, high cost areas will have high trend. And I think that's an irrational fallacy, right? They might have had high trends in the past to get where they are, but that's actually no sound basis to say trend will be higher in those areas moving forward. In fact, I would say there's some conceptual basis to say that because of reversion to the mean and things like that, we would actually expect perhaps particular markets or carriers or whatever with high trend in one year might actually be expected to be lower than others in subsequent years. Again, that's part of why I think looking a little more broadly makes sense. Yeah.
Thank you. With regards to the interpretation that Mr. D'Onofrio spoke with you about the RBC calculation and the 80th percentile, he asked you if the 80th percentile on this would, which the RBC prediction would be 564%, would mean there's an 80% chance that would be below 564%. Does that also mean that there's a 20% chance it will be above 564%?
Correct, given the assumptions and information that are built into that report. I do,
right,
to be less cagey about that caveat. I believe, sorry, I'm thinking about confidentiality. I believe it is in the record that there are favorable headwinds or something to that effect during 2026, trending favorably, something like that. A positive trajectory, my apologies. To the extent that there's a positive trajectory, that whole bell curve would need to be moved in the positive direction, which would mean that 20% would be higher than 20%.
Got it. And this is, I think he was trying to get at how one would consider a percentile within a normal distribution. So that if it was a 50th percentile, the chances would be 50% that it'd be below and 50% that it would be above. Is that your understanding of how to interpret that? Okay, that's all. Thank you. That's it.
Ms. Beliveau, any redirect?
No redirect. Thank you.
Okay, then I think, thank you, Mr. Ruggenberg. We can move on to Mike, healthcare. Sorry. That's all the Blue Cross witnesses for today, right? Oh, and it's a long day. I'm struggling. Eric, please call your first witness.
Sure, thank you. Mike Fisher, why don't you tell us about the challenges facing the market today?
And Mr. Fisher, sorry, before you start to do that, I'm going to swear you in. Do you solemnly affirm that the evidence you shall give relative to the cause now under consideration shall be the whole truth and nothing but the truth under pains and penalties of perjury?
Yes.
Okay, sorry to interrupt. Please go ahead.
So thank you for the question. I know it's late in the day and it is beautiful outside, it appears. Nothing I would rather do than spend the day with you all doing this. I do have a few things I want to say though. Every year I am reminded about this. We sit through this process. We all become familiar with the terminology and the arguments. Like in previous years, I'm reminded that we are all talking about factors with real and direct impact on Vermonters' lives. It's somehow easy to miss. It's somehow easy that it's easy to be distracted by terms like morbidity, loss ratio, utilization trend. Each of these terms and the arguments around them have a real meaning in these proceedings and real impact on Vermonters' lives, but somehow they obscure the human impact. I know everyone in this room is thinking about and cares about how these decisions impact Vermonters in our communities and across the state. But similar to previous years, I think it's important to bring forward at least a few of the voices that commented this year. I was shocked to discover that for my family of 3, the lowest cost plan I could access cost $30,000 a year in premiums and out-of-pocket costs. That's more than half of my take-home pay. Needless to say, my family is now without insurance and hoping for the best. I am currently in need of surgery and am debating whether I can delay this long enough to reach the age of Medicare eligibility. Please leave insurance rates where they are. Too many people would be in dire need or unable to afford rate increases. And finally, we can't afford health insurance premiums this year and are only insuring our children under a catastrophic plan. We get a little insight into what's going on in Vermonters' lives through some of the comments that came this year. Over the years, we have made the point about affordability in humanistic or justice terms. To be sure, those are important frames, but as we contemplate another increase in the context of so many people leaving the market, another important frame comes to me. Affordability is a necessary factor for the business model to be successful. We only get the pool of people who are able to or forced to pay the premiums with the important factor of their healthcare needs. A few more points I want to make I have a few other points I want to make that are not specific to the rate decision for this carrier or the other carrier, but are about the whole marketplace. The first is about the QHP small group and self-funded small group costs. This year, we asked Blue Cross to tell us about the PMPM costs of their self-funded or ASO lives and for their QHP small group. This is shown in Exhibit 12, page 1 in today's binder. The answer gives us a little insight into what's occurring between these two markets. To be clear, I'm not suggesting Blue Cross is doing anything wrong or improper here. They're playing by the rules as defined by our regulators, by DFR here. I realize the board has no regulatory power in this space. I'm speaking today in the context of today's Blue Cross small group case and Wednesday's case about the other carrier's small group. In the small subset represented in this chart, Blue Cross reports in 2025, their ASO groups had a PMPM cost of $629, while their QHP small groups had a PMPM costs of $977. The difference of almost $350 per member per month is not insignificant. Lots of caveats here about what this data means and what it doesn't mean. For sure, the world of ASO coverage in Vermont is significantly bigger than the Blue Cross numbers represented here, but it is at least an indicator that, as we expected, healthier lives are moving to self-funded, leaving behind a smaller, sicker, and more expensive QHP small group. Make no mistake, part of the reason for the high rates in the QHP small group is related to this dynamic. The second issue I want to raise has to do with the silver load factor. Again, this is not about anything Blue Cross is doing or should do. This is about the market. I want to draw your attention to a comment that you maybe have not yet received. It was submitted to the board last night by Stan Dorn from Unidos US. It is not in your binders. It was submitted around midnight last night. I am hopeful that like all the comments that the board receives, that you will take some time to read it carefully and consider the arguments presented. If you don't know Stan Dorn, he is someone who's been thinking about this overload and has had a great influence over us over the years about just the right way to recognize the true cost of the CSR plans. Your current guidance sets the factor at 1.37. I note the alternative load included in the L&E memos, and I also understand that in 2027, in the 2027 Notice of Benefits and Payment Parameters rule, I understand that that rule may give the board some anxiety. Dorn argues, and I agree, that the 1.37 load factor is compliant with the Affordable Care Act, Affordable Care Act's requirements to base rates on the market's single risk pool, which is a key consumer protection provided by the ACA. We must not preemptively comply with the Trump administration's rule that appears to run afoul of the ACA. At a bare minimum, we should hold our ground on the CSR load and seek a declaratory judgment from a federal court. The impact of this decision on Vermonters is estimated by Dorn to be over $45 million. Lastly, I agree with what others have said today, that cost of care is an important tool that the board has to reduce insurance rates and improve affordability. There was a mention just now in the previous witness's testimony, but I haven't heard much discussion that I remember in previous years. That is an estimation of what impact the coming hospital budgets may have or should have on the rate decision before you. Given the pressures so well explored today on affordability, it's my hope that the board consider setting rates for the carriers that is linked to a commitment to reduce hospital budgets in aggregate below guidance. Thank you.
Thank you. Ms. AC or Mr. D'Onofrio, do you have questions for Mr. Fisher?
We do not. Thank you.
Does any board member have questions for Mr. Fisher? Okay, thank you, Mr. Fisher. Does Blue Cross wish to call any rebuttal witnesses?
No rebuttal witnesses. Thank you.
Does either party need a few minutes before we move into closing statements?
I could use a quick break to my computer's about to die.
Yes, let's take 10 minutes, come back at 4.
Thank you.
Thanks.
Just off the record 350.
Are the parties ready to proceed?
Yes.
Yes.
Okay, Ms. Formica, could we please go back on the record?
Sure, on the record 401.
Thank you. So we are at closing arguments. Blue Cross, you can go first.
Thank you. Thank you, Hearing Officer Barber. Good afternoon, board members Holmes, Merman, Walsh, and Teachout, and Hearing Officer Barber. Good afternoon, Mr. Schulteis, Mr. Fisher, Mr. Becker, and the healthcare advocate team. We appreciate the opportunity to appear here today and be in conversation with all of you about these important issues and explain the basis for Blue Cross Blue Shield of Vermont's filed rates in these markets, and to answer all your questions along the way. So I want to make two substantive points in closing, and I'll try to be as quick as I can. First, Lewis and Ellis's recommendation to reduce the medical utilization trend is not supported by the record. It is largely supported by comparison to the public use files, which is a large data set of 2026 trends, in no way sort of tailored to the circumstances around this market. Meanwhile, the evidence in the record provided by Blue Cross supporting its proposed medical utilization trends sits on top of market-specific analysis, years of experience in this market, and that's all laid out in detail in the record, particularly exhibits 1 through 6 that make up the rate filing itself. So given L&E's statement in its report that it could not settle on a single clearly superior trend assumption, confirmed by Mr. Ruggeberg's testimony today, its analysis of this element of the rates falls well short of overcoming the substantial evidence that Blue Cross Blue Shield of Vermont has placed into the record. Second, the record readily supports the 5% requested contribution to reserve in these markets and would not support any reduction of that figure. So board member Walsh really honed in on this as kind of a philosophical crux of this year's proceeding today, and asked several times, several different witnesses, in substance, who should bear how much of the uncertainty in this market as between ratepayers and the company's reserves. And obviously this is a critical question to consider. I want to offer like a gloss or a twist on it, because at the end of the day, it's ratepayers kind of sitting on both sides of that seesaw. The member reserves are the ratepayers' reserves, and allowing a sufficient CTR today, which may, in a sense, cost ratepayers today more than a lower CTR, obviates or reduces the possibility that future ratepayers will have to pay much more in the form of rate shock, similar to what we've seen happen to Blue Cross's reserve position in these in reserve position over the last couple of years. And that's resulted in Blue Cross having to come before you in recent history with much larger rate requests. In part, that's resulted in that. So as we've seen from very recent history, declining reserves can lead to larger rate requests and these kind of rate shock situations down the road. So what I'm kind of like stammering on, but trying to articulate there is, it's board member Walsh's question is about, I think it's more about current ratepayers and future ratepayers than it is about ratepayers and the company or the company's reserves, because in the end, the reserves are member reserves. Commissioner Sampson picked up on this central issue today, unsurprisingly, and I thought his framing was helpful, that together we are all painted into a corner, and that corner is bounded by Vermont's healthcare affordability crisis that this board has called out and remained focused on over the last several years, and Blue Cross's reserve position, which is recovering, but remains in recovery mode. and remains well below the level that DFR considers sustainable, and certainly well below the level where DFR and the company can responsibly take more of that risk on, going back to board member Walsh's question, which I think of as like a seesaw. So Commissioner Sampson also pointed towards a direction out of the corner, which is right now to approve rates that include a CTR that will price the risk inherent in these markets. I think he used terminology very close to that, and allow reserves to grow. And critically, in DFR's role as Blue Cross Blue Shield of Vermont's solvency regulator, they opined that the requested 5% CTR strikes the balance that's needed at this time to start, walking out of the corner. And the record amply supports that 5% figure. Blue Cross Blue Shield of Vermont relied on the best evidence available to it, things known to it at the time when it put the rate filing together and requested the 5% CTR. Those things are the past actual gains and losses in these markets, the known RBC position at year-end 2025 as the best available gauge of Blue Cross's solvency position, the company's experience-based recognition that there will be things that will happen in 2027 that will impact CFR. And I think we all understand and agree that inherent uncertainty is just a fact of life. And the fact that Blue Cross Blue Shield of Vermont needs to continue to add money to its reserves in order to overcome the historical cumulative losses in these markets and the other elements that have over recent years deteriorated its reserve position. Mr. Schulteis mentioned in his opening, and I think there was some testimony around this, that the fact that the company did make money in these markets in calendar year 2025. That's true, and it's a good thing, but we can't lose sight of the fact that over the full run of time in these markets, the company has experienced a cumulative loss, which means it has had to take money out of those member reserves in order to cover losses in this market. So our confidence in that 5% CTR figure is supported by, it is based on those facts and supported by DFR's analysis and the testimony that you heard today from Commissioner Sampson. Sorry, I got lost in my notes there. As Commissioner Sampson testified, the uncertainty inherent in a future RBC projection is, if anything, further reason for why the requested CTR is needed, rather than a reason to question that figure. Again, in light of the information Blue Cross, had in its hands and it used in order to propose the 5% CTR figure. So with the to sum it up, with the agreed upon adjustments to the rates, Blue Cross Blue Shield of Vermont is asking you to approve an average annual increase of 6.5% in the individual market, 4.5% in the small group market. The paper record on its own amply supports those results. The testimony that you've heard here today further confirms those results. And for all of those reasons, we respectfully request that you approve the rates with the agreed upon adjustments. Thank you all very much for your attention, your patience, efficiency, and for the work ahead.
Thank you. Mr. Schulteis?
Sure. So members of the board, thank you. It's been a long day, and I appreciate your attention in this last stretch. You'll have our memo in a few days, so I won't spend this time on arithmetic that you will undoubtedly read. If you remember, I talked about two things in my opening, and I now want to leave you with those two things and explain them in detail. First, what Blue Cross's own measurements say is about to happen in the individual market, And second, the one decision you can make to change what happens in both markets. Start with where we are. Since 2021, the board has approved cumulative increases of 74.6% in the individual market and 51.5% in the small group market. At this year's filed requests, and a Vermonter who bought an individual plan in 2021 is now paying 85.9% more for essentially the same coverage. A small group purchaser is paying 58.3% more on the same basis. Increases like these have far outpaced Vermonters' real wage and real